today, ride-hailing drivers from both Uber and Lyft are striking today, calling on passengers to boycott the companies. Joining us now to discuss all of this and more, the CEO of online lender SoFi, former COO of Twitter, Anthony Noto, who is also launching this gig ETF, Anthony, which I assume includes Lyft, right?
It does include Lyft. We're very excited to be on today to talk about SoFi Invest. But before diving into that, for those that aren't familiar with SoFi, I thought it was important to just solidify what we offer. We're a member-focused personal finance company, all available on your phone or online. Originally started with offering refinancing student loans. We then expanded into in-school lending as well as mortgages, new mortgages, refinance mortgages. In February, we launched something called SoFi Money, which is the best of a checking account and a savings account with high interest, 2.25%, and no fees, and all ATMs rebated. And SoFi Invest is what we're really excited about today, because it's the only place you can buy with no commissions and no account fees, stocks, ETFs, and robo accounts. And today we're launching 2 new ETFs, following up on the 2 we launched a couple of weeks ago to meet the needs of our members.
So basically you're trying to be, what, a full-service bank to millennials?
We want to be a member-focused, mobile-first digital finance company to help people get their money right. And so we want to give products across borrowing, saving, investing, and protecting. And the reason why we're launching the Gig Economy ETF today, as well as the SoFi 50 ETF today, is there really wasn't a way for our members, who are very excited about these gig economy companies, to get broad-based, diversified exposure to these companies. And they don't have a lot of money to invest. They're new investors. They're novice investors. This is a way to get access to companies post-IPO in a diversified way and participate in an economy that they're helping to actually grow.
So you're telling them that it's a better investment to go into an ETF instead of to just buy the IPO Lyft, because there's less volatility and it's more diversified, I guess? Is that the pitch?
Generally, investors that are early in investing are novice investors, and they don't understand individual stocks. And so we want them to invest in things not only that they know, but things that they like in a diversified way, so they avoid some of the risks of single stock concentration. In addition to the fact the amount of money that you need to use to diversify in buying single stocks is much greater than the $20 you need to pay per share of our ETFs, both the Gig Economy ETF and SoFi 50, which are 50 stocks in one fund.
So you started with people who needed money to some extent, and now you've moved beyond that to helping them try to choose how to allocate whatever capital they have. What kind of demographic are we dealing with at SoFi at this point?
Sure, we're going after millennials, 25 to 40-year-olds. They have higher income. They're looking at ways to get their money right. They've been successful professionally, but the reality is the challenges of buying a home and having a family are much more costly today, and they're really underserved. So we're going after people that are underserved, that have done really well academically, have done really well professionally, and they're trying to get to the point where they have enough money to do what they want.
Right.
And so we have to help them get their money right across everything that they do, not just borrow.
It's funny. It seems, you're dealing... Goldman Sachs, your old employer, is making real efforts with Marcus and a number of its digital platforms, going after a higher mass affluent. But it would seem the two of you could find yourself in competition at some point.
Yeah, we're focused on the member and delivering to them value that they don't get today, and they are really underserved. If you think about it, if you want to get to financial independence, you have to get your money right. So investing is not an option, it's an imperative. And the 20 to 30-year-old that's not investing today has to have such better performance if they don't start till they're 30. So we're trying to give them ways that they know to buy things that they like today that are lower cost and lower dollar entry points. Many of the big sort of private wealth management firms don't service 20 to 30-year-olds, and they don't service people until they get to millions of dollars of assets. We're helping them invest today to get their money right so they can reach that
You're
point.
The farm team for those guys, yeah.
So you were at Goldman Sachs, I believe, back in 2011, an early Uber investment. What do you make of Lyft's kind of public drubbing into the Uber IPO?
Yeah, the thing that we've learned over time, whether it was 99 through 2001 or the wave of IPOs from 2010 through 2014 or the ensuing wave of IPOs now, is that when companies go public, they're not used to being public companies. They haven't set guidance. The volatility of their stocks are very high because of both expectations management in addition to low floats. And so buying into an exchange-traded fund like SoFi Gig Economy or SoFi 50 is a way to get access to these IPOs in a more diversified way and a more risk-balanced way, as opposed to taking such risk in individual stocks when they're really learning how to be public companies and delivering performance and driving consistency over time.
Can we tap your IPO expertise and ask what you'll be watching for on Uber on Friday?
We're not watching for anything specifically. There are opportunities for our investors to buy individual stocks.
Oh, I just meant you. I just meant Anthony.
Oh, I would say, I definitely have an interest. I worked on the company when I was a banker and worked on the investment with the rest of the firm and the team. And I have a lot of friends there. I'm personally friends with Dara. So we're wishing them great success. And we want every company that's going public to be successful because it makes the rest of the environment for financing, the rest of the environment for growth, and really capturing this opportunity in front of us better.
Do you believe a lot is riding on how it does day one, week one, month one, in terms of the overall health of the pipeline?
I don't. I think over time, companies that are capturing secular growth, that are allocating capital to drive shareholder returns over the long term will come and go. Any time in the marketplace that somebody's going public, there could be dislocations, but ultimately the value of the company is going to be the current value of its discounted cash flow. As we talk to our members, they really want to invest in these companies, and the gig economy ETF is a way for them to do that in a responsible way to avoid a lot of those pitfalls.
As your targeted demo ages, though, I assume you're going to eventually roll out products that tries to get them to stick with you as they get older. I mean, really old.
Our products can last with you whether you're young or old. It's really about making sure that we're putting the member at the center of what's happening and giving them the best ways to borrow, save, spend, invest, and protect. And we think as we build our membership base, they will stay with us for decades ahead.
I mean, it's nice that you've come on to talk to us. You have raised a lot of money in the private market. Are you yourself eyeing an IPO?
It's not a priority today. It's something over the long term that we'll evaluate, but right now we're focused on continuing to roll out these products to build our mobile distribution. We couldn't be more happy with the success we've had over the last year, launching SoFi Money and SoFi Invest, in-school lending, and relaunching our mortgage product was really critical in making sure we're mobile first. And so the success we're seeing is starting to build on itself. We want to see that perpetuate and focus on growing the business for right now.